yes or no in the questions box. That way I can, thanks a lot, Chris. That was quick. I appreciate that. Thanks, Mike. All right, let's give everybody about 30 more seconds here, and then we'll go ahead and get started. Usually like to give a little bit more time for people to check in. And then I'll be right back. Okay, why don't we just go ahead and get started here on time tonight. Just like to say thank you very much for joining us. I do see a number of names that look familiar to me. Some of you are in my options live trading room. I appreciate you joining us this evening. Again, one more time, good evening, everybody. I want to go ahead and welcome you to our Tuesday night webinar series. My name is Dave Aquino, and I am the options live trading room specialist here at MicroQuant. Again, tonight's webinar will be focused on swing trading Google with options using MQ momentum and value bars. Now, I have selected Google at the time when I established this webinar and the topic, but as we go along, if you want me to look at a specific stock, I'd be happy to do that too. And we'll do that towards the end in our question and answer section in case anybody has any questions about the trading or if we want to look at a different security other than Google. I'd be happy to do that for you. Okay, so again, tonight what I'm going to do is going to touch on and review some fundamental value charts and MQ momentum suite indicators and how they work. Then I'll go into a brief primer on options and discuss how we use them in our trading. And then I'll show you a swing trading strategy that you can use to trade Google options. I'll show you one in particular, but I may talk about a couple of more depending on how much time we have or any questions that we might have. Okay, so let's go ahead and get started here. Risk disclaimer. We at MicroQuant want you to know that trading or investing carries a high level of risk and is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. This content is subject to change at any time without notice and is provided for the sole purpose of education and assistance in making independent investment decisions. ValueCharts.com has taken reasonable measures to ensure that the accuracy of the information contained herein. However, ValueCharts does not guarantee its accuracy and is not liable for any loss or damage which may result directly or indirectly from such content or from an inability to access such information or any delay in or failure in the transmission or the receipt of any instruction or notification in connection herewith. Any past performance results are shown for illustration and example only, are hypothetical, and as such have many inherent limitations. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Past performance is not necessarily indicative of future results. Now, CFTC Rule 4.41. This is a U.S. government required disclaimer. The CFTC wants you to know that futures and options trading not only has large potential rewards, but also large potential risks. You must be aware of the risks and be willing to accept them in order to invest in the futures and options market. Do not trade with money you cannot afford to lose. This is neither a solicitation nor an offer to buy or sell securities, stocks, or options on the same. No representation is being made that any account will or is likely to achieve profits or losses similar to those discussed on this website. The past performance of any trading system or methodology is not necessarily indicative of future results. Okay, now moving on to the topic of tonight's webinar, swing trading Google with options using MQ momentum and value bars. Again, I'm going to first be introducing you to MicroQuant's proprietary value charts and value bars indicator, and then the idea behind an objective value indicator. Next, I'll be exploring MicroQuant's MQ momentum indicator and show you how it works. Then I will briefly touch on options on stocks and discuss how we use them to swing trade. And then we'll talk about briefly swing trading, price momentum divergences on options on daily charts. Okay, before we can start talking about our indicators and setup, I would like to first touch on what we believe are the three most important components of technical analysis. That would be price, value, and momentum. By combining all three of these components together, we believe it provides the most complete view of the current makeup of a market. The tools we're going to use to gauge these three components will be, for price, we're going to use traditional price charts, the traditional open, high, low, close bar charts. The next, for value, we're going to use our value charts and by extension our value bars indicator. And then for momentum, we're going to use MQ momentum. Let's see here. Okay, now the settings we're going to use for our indicators are, for value charts and value bars, we're going to use a 5-bar analysis period. For MQ momentum, we're going to use the default 3255 setting. For MQ regression, which is a trend following indicator that we may use in the later charts, we're going to use a 100-bar analysis period. And then MQ trend, I believe, also comes up. And we're going to use the 21-21-3 setting. Okay, first of all, I'd just like to touch on the nature of value charts, which basically is to provide an objective evaluation of the current price based on the real past prices within an analysis period. Okay, through value charts, prices are placed in 5 primary valuation zones. The first zone is this center green section. This represents fair value. Now the next zones are the yellow zone above and below the green fair value zone. Excuse me one moment. Sorry about that. The above and below the green fair value zone. And this would be moderately overvalued and moderately undervalued levels. Now above and below those two levels are the red extreme valuation zones. And this is significantly overvalued and below significantly undervalued. Now historically prices have existed within fair value roughly 66% of the time. Okay? And then now above in the upper yellow valuation zone, 16% of the time. And in the moderately undervalued yellow valuation zone, another 16% of the time. Now in the extreme red valuation zones, prices are usually in those zones very rarely, roughly 1 to 2.5% of the time combined. Now these percentages can vary slightly depending on the market you trade and the indicator settings that you use. But as you can see, prices tend to stay within fair value, but periodically they enter moderately and significantly over and undervalued levels. Okay, again, this right here, what you see is the traditional open, high, low, close bar chart. Standard charts that have been used for well over 100 years, and they're a good representation of price over time. Okay, each bar represents price movement within a specific time period or for a specific number of transactions when we're talking about tick charts. Okay, what we see here, again, is the traditional open, high, low, close bar chart combined with our value charts indicator. Now, whereas the open, high, low, close bar charts show both the current and historical price information, the value charts indicators show where these prices fall within the 5 valuation zones. As you can see here, these prices in this area here corresponds to the center green green fair value zone. These prices here represent the prices within the moderately overvalued zone. And then here at the very top, we have prices that enter the significantly overvalued zone. And by extension, prices come back down, enter fair value again, and these prices in this area correspond to this area here, moderately undervalued, and these prices down here correspond to significantly undervalued zone. Now, one interesting to note is that you can see how it is somewhat inconvenient to both watch price here and value at the same time, especially in fast-moving markets. So that's why Microquant developed ValueBars. What you can see again here is the standard open, high, low, close bar chart with the open left segment here, the close right segment here, and then the body of the bar connecting the high and the low price of that bar. Now, the only other difference is this again, price is very well represented, but on top of the bar itself, you can see it's been color-coded. Like this bar right here, you have this lower part of the bar, it's green, so that represents fair value. This upper yellow bar segment, this represents moderately overvalued prices, and this top bar segment here, it's red, so this is significantly overvalued zone, and vice versa to the downside. You can see now that this, by representing value and price with the value bars indicator, you can greatly increase the speed in which you both identify price and value all on the same chart. Okay, can everybody hear me? I had one person had a little bit of difficulty. I believe that they're going to log in and log back out. Okay, thanks, Mike. Hopefully Bankasamy can come back in. I will check with him. Okay, thank you very much for that. Thanks, Chris. Okay, let's go ahead and continue here. Okay, so that was our value bars indicator. Now, the next indicator we're going to talk about is MQ momentum. This covers the third component of technical analysis, the momentum of price movements. The tool, again, that we're using is the MQ momentum indicator. You can see that right down here. What MQ momentum does, it seeks to gauge the momentum of a market, which is the strength of a market when it is moving in one direction or another. Okay? This indicator is very similar to a moving average convergence divergence indicator, also known as MACD. But MQ momentum is actually a hybrid, a proprietary indicator designed by Mark Helwig. Mark took the components of his favorite momentum indicators and basically created an indicator that keeps together the most important momentum factors. Now, looking at the indicator itself, we see the indicator line, which is the solid blue line. And then we also see the lagging line or the slow line represented by the dotted blue line. I apologize for this. It is a little hard to see. Normally on my screens in the option live trading, it's a different color. It's usually gold. And then the third part of the indicator we see are these segments here. These are the histogram bars. Now the histogram bars basically show the distance between the two indicator lines. In general, when price momentum is bullish, okay, like right here, you see that the histogram bars are both green and positive. When price momentum is bearish, you see that the histogram bars are both red and negative. This way you can see that MQ momentum provides a clear real-time view of both direction and strength of price movement in the market. That's very important to see both. Okay, so next thing, now we've finished talking about our indicators, let's start talking about options and options on stocks. The first question that comes to mind is, which options should I use? Now, just to step back really quickly, what are options? Basically, they can be thought of as trading vehicles that derive their value from characteristics of an underlying stock. These characteristics are price, implied volatility of the stock, and the amount of time until the expiration of this specific option. Options also have aspects that are desired by option investors: leverage, and that they have a defined risk characteristics. Okay? These characteristics and aspects of trading options are another layer of complexity that we normally talk about in our options live trading room. But for the purposes of this webinar, we want to go ahead and discuss how do we trade options. options provide a lot of different trading tools that we can utilize in a large number of option strategies. We can use puts and call options and combine them and selling them. Provides us with a lot of flexibility in our trading. But for tonight's webinar, we're going to keep things very basic. We're going to be discussing calls and puts as directional option trades. Basically, when we believe that the stock price is going to go up, we go ahead and buy or go long call options. When we believe that the stock price is going to go down, we go ahead and buy or go long put options. Basically what we're doing is using options as a leverage substitute for owning stock. Okay, and again, this is just in the aspect of the first type of trade that I'm going to show you. There are other options strategies that we use in the options live trading room that we can use in swing trading trades, but I'll talk about that a little later. Okay. So then the next question that comes to mind is, now that we know how we're going to use the options, which options do we trade? What strike price do we buy? For the purposes of buying and selling directional calls, we're going to be utilizing in the money calls and puts, specifically the Delta 70 strike price. Okay, for the specific expiration dates, we're going to usually trade stocks that have weekly options, and those usually have anywhere from 2 to 8 days until expiration because they're issued every week. If we're trading a stock that has monthly options that are only issued on a monthly basis, then we're just going to trade the current month. Okay, and those usually have anywhere from 2 to 30 days. There are opportunities where we go out further, but we'll talk about that. Okay, now for the trades, specific trade setup I want to talk to you about first. It's the price and momentum divergence trade. Now we normally do these intraday, but we can also trade these on a swing trading basis. Okay, but let's first define what is a divergence. A divergence is when the price and the indicator, in this case momentum or MQ momentum, are no longer correlated. This is when prices are making an equally high or low prices. When prices are making equal high or low prices while the indicator actually weakens. More specifically, for a bullish divergence, this is when prices go equally low or lower than previous price lows, but the bearish momentum weakens. Okay, that's why it's bullish. Now, for a bearish divergence, we see prices going equally high or higher than previous highs, but the bullish momentum weakens. So you see that the direction of price movement is in either case either bearish, but the bearish momentum weakens. So we're looking for prices to go up or in the opposite direction. When prices are going higher, we see that is bullish, but the bullish momentum weakens. So we start looking for prices to go lower. Okay, this will be a little clearer when I show you on a chart. Okay, look here. Here's an example of a bullish divergence. Again, prices are going down. Okay, they make this first set of lows here. Look at the histogram bars. They are negative and they are red, corresponding to this downward bearish price movement. Prices come up a little bit and then they come down to make a lower low down here. Now look at the difference in the bearish downside momentum. We barely even break into the red histogram bars here. Okay, so price is actually going lower, but the downside or bearish momentum gets much weaker. So this is the definition of a bullish divergence, because when price and momentum diverge, we're actually looking for prices to go up, and they do. Okay, now let's look at it from the opposite point of view. Here we have prices making this set of highs corresponding to this set of histogram bars. Prices pull back a little bit and then make, here we go, new highs right there, and we take a look at the indicator, now the upside or bullish momentum indicator barely breaks into the green histogram bars. Again, first high, first set of histogram bars. Second high, which is higher than the first, and the histogram bars are much weaker. So at this point, we say price is going higher, but the bullish momentum is getting weaker. So there is a divergence, and what we expect actually occurs, prices fall. That's why we call it a bearish divergence. Chris, I'm sorry, I'm just double checking the question that came through here. Chris, you're asking, why do I use the in the money options? Okay, that's a very fair question. Let's go ahead and talk about it. I'm going to use this page here. Specifically, when we use in the money options, it's the nature of the fact that is delta 70, okay? Delta 70. Now, the definition of delta 70 and the functional definition is such. It happens to be in the money because anything with a delta greater than 50 is in the money, okay? The fact it's in the money is kind of irrelevant to us when we're trading it. What matters is the definition of delta 70 is for every $1 that the price of the option moves in the direction we're expecting. That means we have 0.70 change in the movement of the stock, okay? Now, if we're using something that's really far out of the money, like a delta 10 option, okay, for every dollar of price movement in the underlying stock, we only get 10 cents, okay? Now, if these options are $10 and these options are $4, can you see how long? It's almost like the underlying really has to move a lot before it affects the value of the option itself. Whereas here, if this option, the price of the underlying moves $1, it's already moving 70 cents, or $10 goes up to $10.70. Okay? Sorry, I just can't write with a mouse. Now, the thing that's also pretty cool about this is, well, yeah, okay, your answer was even if it moves up, that's correct. Now, if it moves up, the deltas will change. So your delta 10 might go to delta 12, delta 14, okay, but it's incremental. Here, I've seen it where we go from delta 70, and then it jumps to delta 81, then it jumps to delta 90, okay, because it's already in the money. So as things are moving in the direction of our trade, we're actually increasing the rate at which the delta increases our profit. Okay, that is the feature of the option known as gamma. Okay, it is the derivative of the delta. Okay, so it would be great to have delta 10s, to be honest, if you know the option is going to move like $20 on a $40 stock. That'd be great. But when we're talking about intraday or even swing trading basis, you can't look to go from $20 to $40. Here, we make a profit, especially when the options that we trade, Apple, Google, and we're talking about a $400 or $450 stock. Can you see how quickly a divergence move of maybe $5 will make a really big difference in a $10 option? $5 move, delta 70, just keep it simple. That moves up $350, $10 going into $13.50. But that functionally works much better. Usually it'll go from 10 to 14. That's a 40% return right there. So that's why we use the delta 70. Hopefully you guys kind of catch that. Okay, and again, because it's a shorter term trade, it makes more sense to go ahead and use the delta 70. Okay, and delta 70 is just the a guideline. I've used delta 60s, delta 80s, it doesn't matter. What matters is it's a liquid option that price changes nicely with the price of the underlying. Okay? All right, if anybody has any more questions on that, I'd be happy to talk through it later on. But right now, price momentum divergence trade. I'm going to just walk through it, okay? It's really straightforward. Okay, what we have here is Google on a daily chart. Could be anything. Could be Apple, could be Amazon. In our options live trading room, to be honest, I love trading Google. I love to trade Google. Why? Look at the price. I mean, this is I guess a couple of weeks ago. The price is $880. You and I know Google is currently trading at $918. Okay? When this moves within a day or over a couple of days, we can go from 760 all the way to 800. And that's 1, 2, 3 days. A swing trade here makes a big difference. Okay? It really will move, especially with the delta 70 option. Okay? Let me erase this here. So anyway, let's look at again, look for the divergence. Here is the first low. Here is the histogram corresponding to the first low. Prices come back up and they make a second low, which is lower than the first. But when we look at the histogram profile, it's only this bar segment right here that shows up. So when we see the prices going lower, we see the momentum, downside momentum actually weakening. We'll go ahead and establish a position here. We will purchase a delta 70 call because we're looking to see prices move up. Okay. Now this is just a straightforward trade. There's other things we can do, and I'll discuss that. But just for the purposes of understanding the trade, first low, second low, first bearish momentum, second bearish momentum, and you see it diverges, it weakens, so we expect prices to shoot up, and they do. We establish a delta 70 delta 70 call position here, and we actually look to sell at the opposite value level, either here or even up here. Okay, very nice trade. This trade could occur in 1, 2, or 3 days after it. Okay, we do have certain ways in the options live trading room that we manage to, if we see a divergence, we look for an opportunity on an intraday chart to establish a position. Okay, but again, this is the basic trade, again on a daily chart. Let's look at this one. This is an example. Let's look. Prices are coming up. They make this high right here. See the histogram profile. It is nice, positive in green. It is very bullish. Prices come down. They make this, actually they come down in this area, and then they come back up here, make a new set of highs. You can see the histogram bars are right here. That corresponds to this set of highs. So we have higher prices, and in this case we have a declining bullish momentum. So at this point we assume that our trade is that prices will go down, and we can establish a position right on this bar. Actually, this is a very nice doji pattern. We call this a yellow jacket doji, and establish it on that bar, and then 1, 2, 3 days later at the opposite value level, even here significantly undervalued level, we can sell that. Now, just on this chart, this is the range that we're talking about. Up here, where it closes, it's about 620, 622. And when we get into significantly undervalued, we'll just say it's an even 600. So that's a $20 move in Google on a daily basis. So it makes for a very nice trade. Okay, any questions on those two examples of those divergences? Okay, now just one more chart, and then I'm going to go back. I want to share, we still have some time here. I want to share one other type of trade that we can do, and we do in our options live trading room. But this is kind of cool because this is what we see every once in a while, especially if you guys know Google has had a very strong bullish profile over the past 4 or 5 months. And sometimes this happens also. I mean, this is the way, life is not a textbook, and you don't just pull out these trades and go, that's a textbook bullish divergence or bearish divergence. If it was that easy, it would be like picking money up off the ground. But let's just follow the trade. I'll show you why this is kind of unique. I wanted to throw something that was a little bit more like what we see on a daily basis. So first of all, prices shoot up. They even gap up here and make these new highs. This area here, all new highs. See the upside momentum, the bearish bullish momentum, nice and strong. Green histogram bars, very powerful. Prices pull back a little bit in this area here, and then they come up and they make new highs right there. And you see the upside momentum profile is much weaker than over here and in the first set of highs. Okay, so prices actually pull back, establish a position here, delta 70 puts because it's bearish, and we actually reached the moderately undervalued level here, the opposite value level. We buy it yellow and sell it yellow. Okay, so we get out here. What do prices do? They actually go back up. They come up to even new highs here, and then we see an even weaker third set of upside momentum bars, bullish momentum bars. Here we make even equally high or higher highs. See the yellow bar segment here and here. So either of those two bars, you can establish another delta 70 put position, and what happens is prices can just go ahead and drop right there. So this is a double bearish divergence. Okay, here's one trick. Let me show it to you guys. Remember I said we look to establish a short position here. You're saying, Dave, you said buy it yellow, sell it yellow, right? Right there to there. What about all this here? Wouldn't it be better to not sell and maybe until we get down here? Here's a little trick if you guys use MQ momentum. We use this in our options live trading room all the time. Again, the aim is to sell at the opposite value level, but I always tell my folks, don't sell too early. Look at the slope of the fast line, okay? As long as the slope of the fast line is negative, do you all see that? As long as it's negative, hold the position, okay? As long as the slope is negative, the histogram bars usually maintain a longer and longer profile. That means prices are continuing to fall, and that you should stay in the trade until we get a shortening of the indicator line, that we decrease the angle of the negative slope, that when that slope begins to flatline and maybe even turn up here, see that right there, that is when you get out. Don't necessarily sell too early. As long as, and again, let me just erase this so you can see, as long as this slope of the indicator line is negative, this will persist, okay? Because basically what you're showing here is that this, you see the steepness of the indicator line is much steeper than the slow line. That is why the bars continue to lengthen. Once the indicator line starts to lose that negative slope, okay, the slow line will catch up with it. The histogram bars start to shorten, and that is a good location to get out. Okay, stay in the trade, maximize the trade. Okay, another trick we also do is, again, we watch the indicator line, but if we're getting in here with 10 put contracts, we look for opportunities to sell. Probably sell 2 here, 2 here, 2 here, the rest of it here when we turn. Okay, that way we're not selling the whole lot all at one time, but we are being prudent in taking profits as we go. There's nothing wrong with that. Yeah, don't be greedy and want to buy here and sell at the very bottom. You can't do that. If I get 60–70% of the profit potential here, be perfect. Be perfect. let me just see when you have a question. The slope on the first drop was down but quickly went up again. That is correct. There was no yellow on the first drop. Sometimes that is correct. That sometimes does happen. Here's the first set of, let me just see here. Here's the first set of bars. We actually do have this yellow bars. Oh, see, this is a little, again, this is not textbook. This is real life. And usually if we establish a short position here, we'll actually look to sell here. It's a little hard to see. Now if this is your second high here, then you would look to sell here. If this is this second high that you're talking about, we barely got a yellow bar segment here, but really it really didn't. Again, this is why this is kind of textbook. Yeah, that one, this one win. Yeah, you are correct. Oops, hold on. There. Oops, where's my pen? Sorry, folks. Go back to the pen. You are correct. It is much harder to trade this, and we just need to watch. We would, if we got short here, we did have some opportunity to sell here and sell here. Okay, I agree. You really can't see that slope of that indicator line, but it is negative, and then it does change here. It's just hard to see on this particular chart. Okay, and chances are what's going on here is, you see how steep MQ regression is? That's this green line. This is not a moving average or something. This is just our trend indicator. But usually the steepness of MQ regression highlights the strength of the move. What normally happens as MQ regression starts to change its slope from steep to shallow to flat, usually we'll get this. We'll actually have it change the trend, so the trend is to the negative. But normally what we see when we see a change in direction, usually it's a rounding shape like this. You usually see a lot of divergences in this area here before it actually flips. There have been many times where we'll have a divergence right here before it goes from green to red. And it's almost like you're taking the divergence. Okay, it's a bearish divergence because we're making higher highs, but like in this, higher highs, but we have a change in momentum, then we start to go down. Would not be surprised if later on we pop up a little bit and then we continue down, and then this continues down like this. Okay, usually when we see a chart pattern like that, that's when we see that change in direction, and it's usually preceded by a divergence. Okay, I would say roughly, question was how often do we see these nice divergences like this that actually move? I'd say about half the time. But normally when we do take a divergence, that gives us trouble. Sometimes it'll do this. It'll pop back up. It'll pop back up. The main thing we do is we don't normally panic. I know we usually say the stop loss should go up here, the stop loss should go up here. I don't panic right away. I actually watch the momentum, because if I see a divergence like this to this, something's going on. That if it does pop up, if it runs, then we need to get out. But if it only does this, there's a good chance that we'll get the chance to reload and repurchase some puts and then take it to the downside. Oh, that's this blue line again. This is from my screenshot off my charts. Remember earlier I showed you on MQ momentum, the blue line, the solid blue line is the fast line. It's the indicator line. The gold line with the dots, that's the slow line. It just happens to be that one of my attendees can see that better, and I've grown to like that. Is that what you're talking about, Chris, down here on MQ momentum? Okay, yeah, that's all it is. The most important line that I found is actually the blue line. Okay, the blue line and the height of the histogram bars, and then the change in the the change in the histogram bars. Is it getting longer or is it getting shorter? And that helps me also to see the indicator line, the change in the slope. Is that good for everybody? That was my last chart. It's not very complicated to trade. Oh, this is what also I wanted to show you. Okay. Now some of you may or may not be familiar with this. I don't really have the everything set up to describe it, but as you can see, prices move up, okay, and then they come back, and then they make a second move up here. Now the question is do I always have to take a directional trade? Do I always have to buy Delta 70 puts if I think the prices are going to fall? No, you don't. With options, sorry, I can't get the pointer thing right. Hold on. Keep going to the eraser. All right, let's go. All right, so the second set of highs here, your choices are Delta 70 puts because we think that prices are going to fall, or something we do in our room because we trade weekly expiring options. You see how this height of this bar, let's say it is $629, okay, 629. What we can do is sell a call credit spread, okay, that we sell the $630 strike price call option, and then we buy like the 635 call option. So we establish a spread. Because it is a credit spread, for that spread normally we get anywhere from, we say we roughly get 30 to 40 cents per spread, okay? And so that's $40 an option. Usually we do about 10 contracts. And the thing is that as long as prices stay at or below $630, we get to keep the credit, okay? If you don't understand it, just write it down and then look it up after the room. The short strike is at 630. The long strike is at 635. Okay, it's a $5 wide spread. Okay, the risk that we have on this is the difference between $5 minus whatever get as credit. So it's 50 cents. And then we risk $4.50. Some people are like, oh, that's a lot of money. It is true. But basically what we're doing is putting the spread on the understanding that prices are going to fall. And as they fall away, we can buy back the spread for much less. Or if this price stays at or below 630 by the end of the week, then we get to keep all $40 per contract. Okay, that's correct. No, it's not necessarily that case, Ron. Yeah, we risk 460 to make 40, but we have to also understand that when we go and buy a $10 option to make $70 or 70 cents, well, we're risking $1,000 to make $70. Okay, same thing. You always have to risk something to make something. And yeah, when we say risk, you're talking about the difference in the spread. And usually we don't do it this close, but usually what happens is if this does turn around and start to go towards our short strike, we sell out of the position. Normally we will risk 2 times the amount of the credit. Now we do this in the options live trading room differently than everybody else. Most people will say, okay, well, 1 standard deviation up here, we'll sell it up 1 standard deviation away. We don't do that in the options live trading room. Let me do this. Anybody have any questions? Let me bear with me, okay? It's going to be a little messy, but I want to show you guys how we do this. And okay, I'm going to discard the notations. Okay, give me a second. I'm going to show you a live screen. Okay, this is from our options room. Okay, I'm going to remove this. All right, the spreads that we have on right now, we have one on in MasterCard. Okay, here is our MasterCard trade. Sorry if it's a little hard to see. Okay, we do a lot of, this is a daily chart, just like we were showing you with Google, but this is MasterCard. Now, you can see we take a lot of things into account when we put on our spread. Now, right now, we have a $5 wide spread. You see this 605, this purple line? That's how when we have a spread on, that's how we note where our short strike is. So we sold the 605 and we bought the 610 call credit spread. Now that particular trade, we sold 10 contracts, and let me double check here. Oh, that's a little hard to read. Hold on, let me just review my notes. I apologize. I want to show you this because I think it's really cool. We actually have 10, here's my toss screen, okay? We sold 10 contracts of the 605, see that? Bought 10 contracts of the 610. So that's 10 contracts. Now the average price that we received is, I can't do this, man. Roughly $380 is the total credit that we received for the spread. Right now, the spread is, and you can see the chart, prices have actually fallen. They've moved away from the short strike from when we established this yesterday and today, and we are actually profitable by $219. The maximum profit we can get here is $380. Now, we can easily take this profit and just cut our risk for the rest of the week. We don't have to do anything, and we received almost 2/3 of the profit. That's the same thing we did in Tesla here. These spreads that we did in Tesla, you can see they were call credit spreads. I believe I did 10 also, and our max profit here was $660. I went ahead and took it off for a $400 profit. I only had this spread on for less than a day. I could have left it on for an entire week, but as a trader, if I can take 66% of my profit with only 20% time exposure, I'll take that every day and just look for another spread. And that's kind of what we've done. See right now, Visa, another opportunity there. But my point is, and this is the point I wanted to show you on MasterCard, when we do our trade, we don't just do a math formula and say, hey, it's one standard deviation here and one standard deviation here, and let's just put it on. No, we don't do that. It's the same way where we pick swing trades. Here's a high here. What do we see on MQ momentum? We actually see momentum dying off. See how the upside momentum is getting shorter? Actually reached a moderately, it actually reached a red bar segment today. See the slope of the indicator line? It actually goes from positive to flat to negative. Okay, you can see that in the price action. Price comes up here, approaches this resistance level based on the high of this day, and then it starts to turn. Only when we see it start to turn and upside momentum falling off and then downside momentum picking up, that's when we establish the spread up here. And our philosophy is kind of like football. How many layers of defense between where the price is now and our short strike? Okay, that's how we pick how we're going to do our spreads. We want momentum working in our favor. We want resistance levels to be in front of any price action movement that would take us to our short strike. So Ron, you are correct. We do have to risk a lot to get 460 to get 40, but the way we do it provides us a very high probability chance based on support and resistance based on momentum. The same way we pick our swing trades is the same way we pick our spreads. And the thing, this is why I wanted to show you this. Let's say we saw this trade on this day here. We're like, oh darn, prices are already rolling over. We don't want to get in too late here to actually benefit from this stock movement. It's almost like you have to pick the optimum time to go short, to buy puts. And that would have been on this bar. How do we, excuse me one second, how do we still benefit from this price action if it's already started its motion? And we do that, if we can't get it directly from directional trades, then we'll go ahead and write a spread because the spread is still good. Okay? And again, someone can say, well, you know, you're not going to earn as much from spreads as directionals. I will agree with you 100%. But what we do in the options live trading room, and tomorrow is actually a good day to visit too. You see how many spreads we have on? We have a spread in CMG, a spread in LinkedIn, a spread in MasterCard. We did have one in Tesla before we took our profits, and then we have a spread in Visa. Now, we commit roughly anywhere from 20 to 25,000. You can scale that up or down based on what your needs, but we normally have 5 to 6 spreads every week. Now, the way we do it, we structure it so we are earning anywhere from 4 to 6% every week with our spreads on that 25,000. Okay, that's roughly $1,000 to $1,200 every week that we put into our account with spreads. Okay, I mean, I'd love to have all of you guys in my options live trading room. We do certain things. This is a trading intraday, one trade, Amazon, $675. We do directional intraday trades. We put some money in our pocket every day, and then at the end of the week, we harvest our spreads. Okay? I don't want to throw around numbers, but anybody in my options live trading room knows that we do very well intraday. So we put money in our pocket every day, and at the end of the week, we harvest our spreads. Okay, so it really is really good trading. It's kind of a barbell effect. You know, if some of our spreads go against us, what we've done is managed a position that's moved against us, and we've actually intraday traded to make up for any losses in our spreads, and then some. We do that fairly often. I did that with MasterCard last week. The spread actually worked out in our favor, no problem, kept the credit, and we took the intraday profits. It was a win-win-win. So, but anyway, that's another way to swing trade options on a 1 to 3 day basis using spreads. And I really like spreads because the fact is, as long as prices are not through the short strike, we get to keep all the credit. The options live, here, let me go ahead and jump back here. Someone's asking about the options live trading room. Anybody have any more questions regarding the specific trades or anything? All right, cool, excellent. So just want to introduce you guys. I've been talking about the options live trading room. I appreciate you asking. In our options live trading room, we focus on trading setups with options on stocks specifically. We do options on ETFs also, but I do like the individual stocks. These stocks have actively traded weekly options. They provide us with really good option liquidity and pretty tight price spreads that allow us to trade intraday and then 1 to 3 day swing trading setups with ease. One moment, let me get something to drink here. Again, we do directional puts and calls. We do it intraday. We have done them on a 1 to 3 day basis, but we also focus on spreads. And normally, those are put credit spreads and call credit spreads that help us take advantage of time decay on these weekly expiring options. And again, we normally put them on starting Monday into Tuesday, definitely by Wednesday, and then Thursday and Friday, we're managing the spreads, we are taking profits, cutting risk, all those kind of things. Okay, normally we utilize directional puts and calls to put intraday, to put money in our pocket. Okay, the normal trading room hours are 9 a.m. to 1 p.m. and the price is $149 a month. Now, I actually did the math. For 4 hours a day, 20 days a month, that's 80 hours total of trading. That's $1.81 per hour. I can't get my kid to cut the grass for $1.81 an hour. Okay, and trust me, folks, we've been making very consistent money. We haven't been taking crazy amount of risks. And other than some, like with our spreads, someone made a comment the other day. Some trading rooms say, okay, here's the spread. If it goes against you, just take your losses and go. We don't do that. We will actually cut our loss ahead of time, or we will intraday trade to manage the position a little bit more. Okay, if we quote, if we can earn $200 in a spread, we'll risk a $400 loss. But before I take that $400 loss, I'm going to trade that option intraday and do my best to even make up for the $400 loss. I don't like losses. Okay, so if these options, these opportunities sound really good to you, trading options on stocks, and you'd like to experience some more, I think you have to experience it and see it for yourself to get a good gauge of as to what we're about. Go ahead and send me an email at dave@microquant.com. I can help you get a free pass for a couple of days to my options live trading room. I want you to experience it. I want you to see it for yourself. That's the best way. I mean, I'm not here to sell you anything. I can sit and trade in my room all day long and make lots of money. But I think it's a great opportunity to expose yourself to some really good trading, if I do say so for myself. Just give me an email. If you have any questions and not sure about spending the time, send them to me at dave@microquant.com. Let's talk about it, see what questions you might have, and just feel free to come in. Again, the best days to go into the trading room probably are Tuesdays, Wednesdays, and Thursdays. Wednesdays are probably even the best because we're doing intraday trading, we're doing spread trading. Hey, Bernanke's talking tomorrow at 10. It's going to be a great time. So we'll see. Honestly, it's not like the futures room where stuff gets really crazy when Bernanke talks. No, we're okay. We're okay because we have a lot of spreads. We'll intraday trade. It's a lot of fun. So let me just double check anybody has any more questions here. Question regarding MQ regression. You seem to go long or short regardless of the direction of MQ regression indicates. That is correct, Mike. Because MQ regression, the way I have it set, is as a 100-bar analysis period. There's a great deal of lag in MQ regression, the way I have it set. Because you can ask my people in my room, I don't necessarily trade with trend, and I'd say anywhere 60–70% of the time I'm doing counter trend trades. It's just for me personally, it's easier for me to see divergences that way. I don't know why. I look for with trend divergences, but that's hard. They happen less often, I guess. But what I will do with MQ regression is I will note the, here, let me back it up so you can see. I will note the steepness of the angle, okay? I know it's green. I can to be honest, before this tells me it's bullish, if we're in a bullish trend, I'm looking at price action. I can see that this is bullish. I don't need the line to tell me where the trend is. And I actually don't need necessarily the line to tell me when the trend is starting to end. I can see that in the price action, and I can also see it in the number of divergences that usually start to occur here. Okay? But what I do take note of is the steepness of the indicator. If it is very steep, I will make sure that if I take a counter trend divergence, I am actually making sure it's a really, really pretty one, okay? Because it's really hard to find a good counter trend divergence when the indicator line is very steep. When the indicator line is shallow like this here, it's easy to find them. It's almost like the mountain is not as steep, so it's not as hard to go counter trend. Okay, but yeah, I don't. In essence, divergence trade is a lot more likely to be counter trend. If you think about it, what's going on? If we're going from one high to a higher high, then chances are price action is going up. It's a positive line. So we're looking to do counter trend. And that's why it tends to be counter trend. Again, I'd much rather be counter trend here than counter trend here. It's like asking for trouble. But there are instances where I do counter trend also. Probably get me in trouble. Hold on, let me show you something else. Like I said, I enjoy sharing stuff with people. Look at Google. We traded this the other day. Here's another thing we do in the room. And sometimes it works out very well. Oh wait, I'm sorry. Okay, we're almost out of time. Okay, really quickly. Let's see if it's here. Sometimes we make this trade in the room. I should just tease you guys about it so that way you'll come join me in the room tomorrow. Okay. We actually, not that one. We trade at the open. And we trade gap fills here. We gapped up a little bit in Google. We went up to this point here. We got short here. We're like, oh my gosh, Dave, you're going short? Well, it has everything to do with the way it's set up. You see how MQ Momentum's histogram bars are falling? Do you see how the indicator line slope just dropped? You see how prices are going up? This is almost the essence of a divergence. We have higher prices, we have falling momentum, and then the indicator line just dropped. We actually went short here with Delta 70 puts. I wouldn't say short. I mean, we were looking for prices to fall. And then, while I was putting the order to actually sell some of my 10 contract position here, we hit this air pocket, and all of a sudden we drop here to 921. Okay, that's support, and then once we broke through support, we dropped some more. As you can see, this went from 926 all the way to 919. That is a 7-point move. Okay, we had 10 contracts. We made a little over $2,300 in that one move, and we went short at, see, this is 9:32 in the morning. This is 9:34, 9:35. This is 3 minutes. Made $2,300. Sorry, it's not, okay, I'll say it now. Past results is not indicative of future results, okay? But I thought it was a really cool trade. We were actually just looking to go from here to here, to be honest. And that was like a $2 to $3 move. But we did that trade, and that thing just, whoosh, it happened so fast. When we got down here, I was scrambling to sell the positions before it popped up because it's significantly undervalued. But that was a good trade. And I can see the names in here. Some of you guys were in the room with me. So, but those are kind of trades we do. I think a little earlier I don't know. There's a good number of divergence trades there. And I think what also happened this day, what day was that, the 15th? That was Monday. We had 4 different trades within the first hour and a half, all within Apple, Google, Tesla, and Amazon. All of them. And all 4 were profitable. Not to the extent of Google, but Apple was good, Google was good, Amazon and Tesla were profitable. A couple of $100. Apple was like 1,000. So 10 contracts. Yep, 10 contracts is what I was normally trade. So please come join me. I'd love to have you guys, and then answer any questions that you might have. Let me see if I can get that back up here. Again, if you have any questions, please email me, dave@microquant.com. If you enjoyed the webinar, please email me also. Be happy to have you. Okay, anybody have any last minute questions? Okay, excellent. All right, well, again, thank you for taking the time to spend with us in this webinar session. Again, I hope you found it informative and exciting. Any questions or comments can be directed to support@microquant.com or sent to me directly, dave@microquant.com. Again, my name is Dave Aquino. Have a great rest of your evening and good luck trading. Thanks again, guys. Bye-bye.